Global dealmakers are on a tear with mergers and acquisitions on track for the second best year ever. About $80 billion worth was inked just on Monday, but risks are brewing, including weaker U.S. economic data and an uncertain outlook on rates. Live from Singapore, this is Insight with Haslinda Amin. In the next 2 hours, we'll dive deeper into the stories that matter with crucial context and sharp analysis.
CEOs are unleashed in believing that they have a chance of doing strategic things to advance their position, to advance their scale, to advance, how they sit competitively. And so we see a tremendous backlog of significant consolidating situations, what I'll call large cap M&A.
As deal-making surges, the world's top bankers are in Hong Kong. We'll speak exclusively with Morgan Stanley's CEO Ted Pick in just a few minutes. With AI driving much of the deal-making spree that's boosting stocks, GQG Partners portfolio manager Brian Kersmanc weighs in on the bubble debate. And in India, IPO valuation are sparking concerns. We speak to the CEO of DSP Mutual Fund, which made the rare move of defending its investment in an offer. Dealmakers have sealed mergers and acquisitions worth more than $80 billion in a single day as they hurtle toward their second best year on record. Leading the latest haul is Kimberly-Clark, which agreed to buy struggling Tylenol maker Kenvue for roughly $40 billion. That tie-up would allow the maker of Huggies and Kleenex to overtake Unilever and become the second biggest seller of health and wellness products after P&G. Meanwhile, Starbucks agreed to sell a majority stake in its China business to private equity firm Boyu Capital at a $4 billion enterprise value in a bid to improve the coffee chain's future fortunes in the country. Now, companies have been transacting at multi-billion-dollar amounts across a range of industries, with the artificial intelligence boom one of the major themes behind the recovery in deal-making. Among the Wall Street banks, Goldman Sachs Group is the top advisor on deals globally. According to data compiled by Bloomberg, it has worked on more than $1 trillion worth of transactions this year alone, a figure that could rise to an annual record for the firm. Now, in fact, we just spoke to the CEO of Goldman Sachs, who told us there is a tremendous backlog of deals. Big deals, in fact, as companies look to achieve scale. David Solomon is in Hong Kong for the annual summit hosted by the city's Monetary Authority.
So the U.S. is a huge part of the global M&A market, either for target or acquire.
Right.
I would say it's extremely constructive, and we see it, in our advisory business. You can take a look at our, M&A revenues last quarter, which are a reflection of deals closing. But if you also go through our earnings call, we made a comment about the level of our M&A backlog,
yes.
The very high level of our M&A backlog. Yeah. And that's just an indication of the fact that there's a lot of activity inside the firm. I'd say this is really rooted from the fact that we went through a period for 4 years during the Biden administration where if you wanted to do something strategically, if you wanted to do something significant from an M&A perspective, whatever the question was, the answer was no. We're now in an environment where whatever the question is, the answer is maybe. And I think CEOs are unleashed in believing that they have a chance of doing strategic things to advance their position, to advance their scale, to advance, how they sit competitively. And so we see a tremendous backlog of significant consolidating situations, what I'll call large cap M&A. Large cap M&A in the United States is up very, very meaningfully. Deals over $10 billion, very, very meaningfully year over year. And so I think we're in a pretty constructive environment, and my expectation is 26 and 27 will be quite constructive in terms of large cap M&A, particularly in the United States.
Obviously, we've been talking about AI. That's a big thing in terms of how does it work for Goldman Sachs in terms of operational efficiencies? How does the onslaught of AI really going to impact how you hire or even just headcount in this part of the world now, David?
Well, it's interesting to me that you go right to headcount, and I actually think that that's a different lens than the lens that we would look at. And I don't know if you saw, but when we reported earnings 2 weeks ago, we put out a memo that we called Goldman Sachs 3.0, where we highlighted the approach that we were taking to integrating AI, and we talked about a handful of things that were goals, including operating efficiency, automation, better sales management, and then we identified 6 processes that we were going to look at from a very fresh perspective to see if we could automate them and build better efficiency so that we would have more capacity to invest in areas in the business where we see growth opportunities. And so, I think for a firm like Goldman Sachs, there are 2 avenues here. One, we have very smart people.
Right.
And we can put these tools in their hands, and that makes them more productive. And by the way, that's no different than 40 years ago when I was starting and somebody gave me a desktop computer and Lotus 123 software, and I had the ability to do a spreadsheet in a fraction of the time that it took me before that tool was put into my hand. That just continues. That's been going on for 40 years. It doesn't mean we have less smart people inside Goldman Sachs. If you look at Goldman Sachs productivity per person, it's much higher today than it was 25 years ago. And my guess is 25 years from now, it will be much higher than it is today. But our goal is to figure out ways that we can invest in growth, because we see lots of growth in our franchise. By using AI technology to reimagine processes, we can create operating efficiencies, and it gives us more of a scaled opportunity to reinvest in growth in the business. And look, of course, over the way, there are going to be shifts in jobs and job functions, as there always have been. I think one of the things you've got to wrestle with today is the pace of this is quicker. And so since the pace is quicker, there's a chance that it might be a little bit more disruptive, in the short term. But at the end of the day, technology changes jobs, it changes the way people work. This has been going on for a long, long time. It is continuing. I don't think it's different this time.
Goldman Sachs CEO David Solomon speaking with our very own Yvonne Mann and David Inglis. Now, with deal making surging and stock sales running at a 4-year high, let's get the market outlook from Brian Kersmanc, who's portfolio manager at GQG Partners, a boutique investment management firm which looks after about $150 billion in assets. Brian, good to have you with us. I mean, obviously, deal making, a big theme in the markets, whether it's AI, non-AI deals like we saw in Starbucks. I'm just wondering, what are you making of the theme? Will it continue to drive the markets for 2025, the rest of 25, and perhaps 26?
Yeah, so I think there's 2 buckets that you can put the M&A theme into. You can put them into sort of the Starbucks bucket, where you do have some asset sales and things along those lines, maybe some consolidation of businesses like a Kenvue going under sort of a better ownership in the grand scheme of things. And then you have that other bucket, which is the AI bucket and the more the technology bucket. And I think that's the one that's been a little bit more interesting to us, not necessarily from an investment positive opportunity, but you are seeing sort of the narrative and the size of these deals becoming larger and larger. And we're getting increasingly, honestly, concerned about the circularity of a lot of the deals that are coming through on that side of things, the announcements there, and the lack of sort of backing of where you're actually going to get the cash flows in the grand scheme of things for some of these the deals that you're seeing funded over on that side of things. So that's where we're a little bit more concerned, I would say, and feeds into some of the AI skepticism and the tech skepticism that we have at this point in time.
So how are you assessing the risk from that value, right? You talk about how the deals are getting higher and higher, bigger and bigger. Where do you sit on whether to invest in them or not? Some say, where is the value now?
Yeah, so even beyond the value, it's the nature of what is it sort of describing about the market. So if you have these vendor financing types of deals where you have the chip maker in NVIDIA who's actually investing in dozens of folks that are doing AI, and they're the startups of AI, and then 3/4 of those investments are then going back to NVIDIA on the other side of things, well, that's fueling that cash flow, and that money is just being bounced back and forth. And it takes larger and larger sort of deal announcements to continue to perpetuate that narrative. What we're seeing is a little bit more of a lack of that external capital that's maybe coming in. We're seeing some cracks in that sense where it is a little bit more of that vendor financing coming through. I guess to ask it in an opposite direction is if this AI theme, this AI investment was so fantastic, why are we not seeing more of this external capital coming into the system? Why are we seeing that the internal players are having to invest in each other to sort of keep this flywheel going, so to speak? And when does that stop? And that's one of the things where we're questioning ourselves right now.
Well, I guess it stops when people start questioning the kind of capex that being invested in these companies. When do you see it stopping? At what stage do you get worried and perhaps take a step back?
Yeah, so two things I would kind of describe there. Number one, right now investors are rewarding companies to a large extent for the more larger your capex numbers are, the more that you're growing into sort of a future revenue opportunity as it pertains to AI. I think you will get to a certain point, and we've seen this in different points in the past with some of the hyperscalers and some of the Mag 7, where you're not necessarily getting that level of return. So spending 30% capex to revenues and not necessarily seeing enough of that growth, people start to question them. They saw that with Alphabet last year when they weren't quite growing fast enough, when people thought that maybe they're being disintermediated like a chat GPT at that point in time. They hit that threshold and multiple derated. You looked and saw this previously with Meta in terms of the last cycle, when Meta hit the sort of the pause button on investing in the metaverse. People were penalizing them for spending way too much money and not really getting a return. So you have a couple of those things that have come through previously. The second part of this, which I think is even more interesting, is when you start to see that maybe some of these chip sales are not coming through maybe as robustly as you thought they were going to. We've done some channel checks ourselves, and we're noticing that GPUs are selling at a pretty dramatic discount. Even the more recent ones, the H200s, we're finding pricing through distribution channels and things like that are maybe 30 to 40% discounted to sort of the MSRP price. And these are the more recent chips that have been made available into the market. And then you see this in terms of the GPU rental prices as well. We were quoted, GQG was looking at potentially renting some GPUs for ourselves for our own use. And we were quoted $3.70 for a GPU rentals. Now, if you kind of put that in context, the latest GPUs are running at about $50,000. That's like you're taking a $50,000 car and you're being able to rent that out for $3.70 an hour. The math just ceases to work on a longer term basis there.
Some say there is a counter argument to your argument, and that has to do with earnings. When you take a look at the earnings of these big tech companies, they actually justify the upward momentum of the stocks. Do you buy that?
So to some extent, yes, but I think there is a cap or maybe a limit to where the earnings can go from here. And why do I say that? You are seeing with the accounting of some of these businesses that they've stretched out the duration of sort of the depreciation, for example, on the GPUs and on sort of these data center and networking equipment. So back in 2020, most folks were depreciating data center and networking equipment on a 2 to 3 year basis. And then as ChatGPT came through, they started extending out the duration of that depreciation to 5 and 6 years. Now, kind of doesn't make sense because if you think about a lot of these chips, you think about being obsolete or burning out within a year or 2 years. So how can they possibly last 6 years? And that's one of the questions we have. But if you think about the real numbers of this, that adds billions of dollars in net income over the course of time as you just stretch out by 6-month increments on these things over the course of time. So I think there is a little bit of not necessarily nefarious overstatement, but I think is a little bit aggressive accounting, I would say, that's going into some of these things over the course of time. And that's something else we're getting a little bit nervous about. There's also an increased use of things called SPVs, special purpose vehicles, where you're taking some of these assets from the companies and instead of putting them on your own balance sheet, you put them into the special purpose vehicle and then it doesn't show up as debt on your balance sheet. Or if you have to write down those assets, it doesn't necessarily show up as impacting your P&L. But that is real economic impact that ultimately happens to these businesses. So I think you're seeing some of these later stage accounting things and games, so to speak, that are being played that aren't necessarily wrong, but I would argue they're very aggressive and maybe take a little bit of the shine and sheen off of the earnings growth that you are actually seeing out of these folks.
Brian, if you see the AI trade as a wave and waves don't go on forever, how would you position yourself in this space?
Yeah, so what's interesting about that is that it's not even just the AI companies or just sort of the data centers or the hyperscalers or the cloud businesses. What we're finding interesting about a lot of these things is that there are so many things within the market that are tied to this exact theme and this specific theme. So what am I referring to? If you think about what are the best performing assets within Europe, for example, in industrials, they're the European cap goods companies that are supplying the electrical equipment or the turbines for power and things along those lines. If you look at the best performing assets within the EM space, you think about in Korea, you think about the chip makers, specifically memory, high bandwidth memory or foundry business. Think about even in the US, what are the best performing utility assets within the US? They're unregulated utilities where there's a perceived power in demand in excess of the power supply that's going to happen there. So the prices are going parabolic in terms of pricing. Well, if any of that unwinds, if some of that capacity isn't necessarily coming through nearly as fast as we're thinking it has to come through, we're seeing a lot of signs that that's potentially the case on top of a market that's already priced to perfection. There's a whole host of things that are all basically priced on the same underlying theme, which is this undertow of an AI theme. So that could potentially unravel in a lot of different areas and a lot of the things that, quite frankly, have done really well on a year-to-date basis or a trailing one-year basis. So that has us nervous, and we're trying to stay away from those types of investments at this point in time.
And Brian, one other factor that's shaping market thinking is actually the dollar. So much for dollar demise. It's now back to being resilient. How is it shaking up, how you invest for the quarters ahead?
So the way that we think about currency on a longer term basis is what is the differential in the CPI and sort of the inflation rate. And on a longer term basis, you have these trajectories that continue to play out. I do think eventually the dollar will continue to devalue over the course of time. But it is more about those longer term differentials that we have there. And the way that we invest is we dollarize our assets. So if it is a country that has 500 basis points faster inflation than the US over a long term, we'll dollarize that. We'll look at in sort of a 500 basis point handicap to that. So it's much more a long-term game, I would say. But yes, there are sort of shorter-term impacts that happen that sort of help or hurt the imports and the exports of certain countries. And we've seen that happen over the course of time. But again, these are longer-term structural themes that I think will play out over the course of time.
Brian, hang tight. Brian Kersmanc of GQG Partners is sticking around as we take a deep dive into the Indian markets. Also coming up in just a few minutes, our exclusive interview with Morgan Stanley Chairman and CEO Ted Pick. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Indian equities have seen the highest net selling by global investors in 2 months. Latest data show that funds sold a net $855 million worth of Indian stocks on October 31st, which was the most since the end of August. On the other hand, global funds also bought nearly $28 million of debt, marking the 5th straight day of buying. Brian Kersmanc, portfolio manager at GQG Partners, is still with us. How are you making sense of those numbers there? It does seem, when you take a look at year-to-date, $16 billion making an exit in terms of foreign funds. That's a huge amount.
A decent amount of selling, I would say, but in the grand scheme of things, what we are seeing on the opposite side is a decent amount of retail buying and sort of local investor buying still coming into those names over the course of time. And if I take a really big zoom out, what is interesting about India in general at this point in time? Number one, think about all the countries in the world we've talked about, fiscal stimulus and or deregulation and things along those lines, and the hopes that that would be coming. Well, we've actually seen that happening within India over the past several years. And it's actually having an impact, and we're seeing that in terms of the businesses that you can invest in within that, whether that be on the infrastructure side of things and the utility side of things, or even on the banking side of things. So yes, there might be some ebbs and flows in terms of investor appetite and things along those lines, but the fundamentals are incredibly strong when it comes to India. Just to give you a couple of interesting high-level data points, because I think it goes underappreciated just how strong the growth is. One of our company's subsidiaries actually does toll roads, and they built 500 kilometers of toll roads last quarter. That was on top of 800 kilometers of toll roads the quarter before and 700 kilometers of toll roads the quarter before that. That's roughly the distance from sort of in the Northeast here in the U.S., Boston to Washington, D.C. in the course of a quarter. So you're seeing a tremendous amount of growth that's coming through, and a lot of that's being facilitated by the programs that are happening and sort of by this easier policy that the government is allowing in order to allow these big growth projects to happen, coupled with the demand for that.
But it's weak rupee, weak consumption, and some say for India to create the jobs that it needs for the economy, it needs to grow beyond 7%. These are fundamentals.
Yeah, so I would agree that from a consumer standpoint, there might be a little bit of softness in that arena or things along those lines. But what we are seeing in other areas, as I mentioned before, on the infrastructure side of things, the utility side of things, even to some extent on the telecom side of things, you see tremendous amounts of growth. So I would agree with you if you look at more of the consumer staples side of the business, where you see some of these businesses trading, in excess of a 40 or 50 times PE multiple, and you have weaker growth, low single digit type of growth. I would agree with you that that's not necessarily the most interesting place to be. But if you see some of these other banks, especially the ones that are geared a little bit more towards the business side of things, or even sort of government lending to a lot of these subsidized projects and things like that, you're seeing strong double-digit loan growth at a reasonable valuation over the course of time. So that still looks incredibly attractive to us. And those are more of the types of opportunities that we're exposed to within India. Again, it's not necessarily about the entire macro and investing in the country as a whole. It's actually a lot more about the incredible opportunities. And again, we see a tremendous amount of growth in these assets where you don't typically get that kind of growth or that that visibility at the same time. We're talking 10 to 40% EBITDA CAGRs out of some of these businesses with ridiculous amounts of visibility. So that's what's interesting to us.
Earnings is something that we're all watching. We have Adani Enterprises out with numbers. What assumptions are you making about how well this company would do?
Yeah, so what's interesting about these businesses is, again, they're very long-tailed in terms of the visibility. With Adani Enterprises, the various subsidiaries that they have within, again, that toll road construction business. You also think about the Adani Airports business as well. They have built an entirely new airport operation or entirely new airport outside of Mumbai. It's the second airport. They did it in less than 5 years, and it's actually running at this point in time, and it will be a top 5 capacity airport globally. So you have tremendous amounts of tailwinds in terms of the growth in passengers, and then also the airport business itself is a very attractive business. So you have the regulated side of it, you can charge for the passenger throughput, and then you have all the commercial businesses that you're captive. I think we've all bought a bottle of water or something within an airport terminal and been charged exorbitant amounts of money just because we're past the security lines. These folks monetize all those types of things, and much more attractive valuations for their airport assets if you see those underneath the Adani Enterprise hood versus virtually every other airport in the world that is growing much slower than what Adani Enterprise is seeing.
Obviously, not everybody agrees. The stock is down 2.5% year to date, but there are those who say it could climb 40% from here. What would that take? And what's the likelihood of that happening?
Yeah, so our view is that earnings are like gravity. So as long as the companies continue to put up, these robust earnings over the course of time, the market will appreciate the growth in the businesses over the course of time. I don't believe that you're going to see a multiple derating from here. These are actually priced at pretty attractive levels here. Again, if you do any sort of sum of the parts on any of the businesses for Adani Enterprises, you actually see that there is tremendous amount of value that's unlocked, especially if they spin off some of these businesses. So we're continuing to be very constructive. But again, this is just one investment of a much larger pool of investments that we have in India that are, even outside of the Adani ecosystem. In fact, most of the investments we have in India, by a large majority, are outside of the Adani group.
Right. Brian, as always, great to have you with us. Brian Kersmanc of GQG Partners. Now, still ahead on Insight, we're live at the HKMA Global Financial Leaders Investment Summit in Hong Kong. M&G Asset Management CEO Joseph Pinto will be joining us exclusively. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're keeping an eye on the RBA out with a decision momentarily. Markets expecting the RBA to stand pat because of sticky inflation. The key question really for traders is whether the RBA will signal it is keen to resume cutting should inflation eases in the coming quarters. The recent stickiness of the inflation figure in Australia underlines the conviction that the neutral rate has shifted higher since the pandemic. The RBA is out with some of the headlines right now. It sees core prices above the target to mid-26, stable job environment. It has capped its cash rate on hold at 3.6%. It says inflation has indeed recently picked up. In terms of its GDP, it says the growth this year is slightly weaker. Domestic economic activity is recovering, and the outlook remains pretty uncertain. Again, the RBA has set its cash rate at 3.6%, pretty much in line with what markets expecting, standing pat, leaving cash rate steady at about 3.6%, in line with expectations. The reason for that is inflation remaining sticky in recent months. Now, we'll bring you the latest lines out of the RBA in Australia slightly later. For now, let's head back to the HKMA Global Financial Leaders Investment Summit in Hong Kong, where David and Yvonne are with our guests right now. Dave, Yvonne.
Yeah, there's lots to talk about, and I want to borrow just what you just said there, expectations around these markets, right? Where expectations really hold the vast majority of people we've spoken to here almost one-sided, right? Markets keep going up, and the last panel we just had here inside really talked about, we heard from the Goldman and Morgan Stanley CEOs talking about how, you know what, every now and then markets can fall, and it doesn't take a big trigger for markets to fall 15 to 20%. Something to expect, question mark, going into next year. Joining us here on set, Joseph Pinto, CEO of M&G Asset Management. Good morning, sir, and thank you for taking the time.
Good morning.
Very nice to
Pleasure
see
with you.
You were inside just now
Absolutely.
and listening to some of the panels. Anything stand out to you?
Well, first of all, it's great to have all the vibe again in Hong Kong.
Yeah.
Very impressed by it. Well done, HKMA, to have organized that great event. All these CEOs effectively in the room. I do believe that there is a case for, investing again in the markets in the long term. As you mentioned, there could be eventually a drawdown, as some of the peers have mentioned it. Yet there is a belief in that the market will continue to grow in the medium or long term. So you don't want to be missing out that growth, but not be afraid of having a market correction eventually.
What is how do you build that resilient portfolio now? Right? When you look at geographies, strategies,
It's an excellent question.
Yeah.
I think what's key and what we learned from all these tariff issues that launched by Trump in April, you remember where we were all and where the markets were.
Yeah.
I think the key message we've heard, key lesson learned is diversification. Clients were overly invested in the US, and now we've seen diversification geographically, more flows coming into Asia, more flows coming into Europe as well, and two, in terms of asset classes as well. Equity, fixed income, but also private market. And we want clients to build their private market portfolios, not only institutional clients, but also retail investors progressively benefiting from, let's say, the excess return private market can offer over public. So as a consequence, we've seen effectively clients slightly divesting from the US, and we've seen more flows in Europe, but also in Asia, and we benefited from it.
I want to pick up on the private market comment because it's become from something that's nice to have to must have, really, for many investors. What type of investors do you think need to have private market exposure, and why do you think that's critical at this point?
I think I'd like to start with the why. Why, should investors benefit from private market? You have great firms out there that are decided not to be listed. It's a choice. And they can provide great returns, both in the equity format or in private credit format. So private equity or private debt. Why not benefiting from it, if you think about it? So our role is to provide the wider universe of investments to investors out there. So first and foremost, institutional clients have been investing a lot into the private market space, and we talk about more and more about democratization of private market. I just want to say a few words about it on these retail customers. First and foremost, you need to educate them. You need to educate the intermediaries who promote those strategies, and you need to make sure you have the right regulatory framework behind it. So LTIFs in Europe, continental Europe, or LTAF in the UK are great regulatory schemes or vehicles that help investors, retail customers, invest into private market products. Then you need, as I say, educational programs. We build a very heavy one where we decided first to provide the best of private credit of M&G to private clients with 9 educational models where we educated our, let's say, intermediaries, financial advisors, private bankers, so on and so forth, themselves to know how to position such a product to clients. It's really critical to really explain all the terms of such strategies and why investing in private credit as a good diversification to public credit for retail clients.
It seems like everyone's kind of delving into this space, right? And as we see this kind of private market boom continue, does it make it easier or harder for you to kind of sort and look out for actual quality sort of companies now? Does it make it harder or so?
I think what matters the most indeed is to believe in your fundamentals, to have strong risk management processes. We rely on a very big research team, credit research team. We review a lot of companies, a lot of potential investments. We probably invest only in less than 30% of them because we tend to be extremely selective in where we deploy clients' money into. So it's important to always have those philosophies of investment and stick to it because quality matters in the long term.
Can I ask you about your plans in the region? I think you just mentioned you renewed your license for here in Hong Kong. Just help us understand what your growth priorities are.
Yeah, in Asia, absolutely. Probably I'll also go linking back first to private market before. As a firm, we manage $440 billion roughly, almost 100 billion in private market, 340 in public markets. If I look at now the split geographically, we've been coming and accelerating in Asia more recently. We manage probably $55 billion in dollars of various Asian asset classes, equity, fixed income, and real estate, mostly.
Okay.
We have close to 200 people across Asia, and we've been growing more and more. We've extended our license in Hong Kong to access more retail customers in Hong Kong. We've partnered with the largest broker in China, Guotai Hanong, and they are our partner now, promoting the best of M&G products for Chinese customers.
Okay.
What's sort of the conviction around China now? I mean, it seems like right now, equities are in a bull run. What is sort of the sentiment around the mainland now when you have your conversations here?
So we launched, by the way, a Chinese equity strategy, but also a Chinese credit strategy last year. We're very proud of that. Last week's meeting between Mr. Trump and President Xi was quite revealing to feel that there could be a win-win from a tariff standpoint between the two largest superpowers of the world that will benefit from, let's say, investors and also any operators in China. So we are positive, therefore, today, as we have a better perspective on where and how to invest in China.
We have to leave it there. We could spend all day, of course, with the plans. Please, of course, let us know next time you're in town. Let's do this again soon.
A pleasure. Thank you.
Joseph, fantastic. Thank you so much. Joseph Pinto there, Has, CEO of M&G Asset Management. Back to you, Has.
And what a great lineup from the HKMA event. Now, still to come, we'll have more from the HKMA Global Financial Leaders Investment Summit. Exclusive insights from Morgan Stanley Chairman and CEO Ted Parekh coming right up. Keep it here with us. This is Bloomberg. Welcome back to Insight. Inflation remains a risk. We have the RBA standing pat, keeping rates at 3.6%, warning about inflationary pressures. We also have, coming out of the U.S., Semaphore reporting that Goolsbee saying that the government shutdown is shifting risks to inflation. So again, inflation front and center for governments. Let's head back to the event where David and Yvonne are with our next guest. Take it away, guys.
Yes, absolutely. Has, thank you so much. You might have caught a little bit of a sneak peek just now there with our next guest. Of course, lots to talk about, lots to discuss. Joining us here on set exclusively, Ted Parekh, Chairman and CEO at Morgan Stanley. Ted, a pleasure to have you on the show. Thank you so much for taking the time.
David, Yvonne, thank you so much. Great to be here.
Quite a buzz in Hong Kong.
Buzz, real buzz.
Right? You've
Excellent.
been here. You come here a lot. This part of the world.
Many times.
Does it feel different?
Feels good.
Okay.
Feels good.
What's different, do you feel?
I think people sense that some of the U.S.-China tension has normalized a bit, and that the capital markets are receptive to new product. I mean, the reality is that the China progress through COVID and coming out of COVID has been spectacular across multiple industries. As you well know, you report on every day, AI, robotics, EV, biotech, and now Hong Kong being the fulcrum to raise capital. Pretty exciting when the capital actually starts coming to market. So you had sort of the green shoots of the development onshore, but now you have the global capital markets being receptive.
You guys have probably the best position in terms of this resurgence in IPOs and equity capital markets raising here in the city. I had to look at the league tables. I won't disclose the actual number. You know the number. Help us understand what the competitive environment is like for deals, given the resurgence that we've seen in activity here, and what's the appetite from non-Asian-based investors to participate in all the fundraising that's taking place here in Hong Kong?
First of all, I love the setup to the question, so thank you so much.
Yeah, I did disclose the rank, though.
I really appreciate that. The team stability has been remarkable, beginning with Gokul Leroy and then the heads of banking, George Taylor, Shane Zhang, heads of equities, Ben Walker, head of fixed income, Nal Almeida, and then #1 research for a decade plus. You've interviewed all the analysts.
Yeah.
Having stability matters out here.
Okay.
It matters. And when we think about the diversification of the Morgan Stanley businesses, Asia has always been a site of comparative strength, which means you need to come, you need to be here. When things are good, when things are less good. But the reality is China is the second most liquid market in the world, and asset managers are going to want exposure. So when times are a little tougher, maybe they'll be underweight and maybe it'll be beta, be more passively held. But when the animal spirits are kicking in and when there is clear advantage being struck by winning companies, they want alpha. When they want alpha, they want company-specific allocation. So that's when the new issue environment becomes so important. And we're having a great run thanks to that leadership, bringing companies to the public sphere.
Yeah.
And it's not just the progress in Hong Kong relative to Asia. It's that Hong Kong, as you know, is the most active IPO market in the world. Quite extraordinary.
Yeah.
And that's going to continue, and it's across industries. So if you are an investor and you're interested in one piece, robotics or AI or EV or maybe gold, metals, you have opportunity across sectors.
How do you look at it competitively now in terms of ECM business? Because it seems like the landscape has changed. I think 5 years ago when you asked us, could a Chinese bank be among those league tables? That probably answer was no. But now you're seeing them rack up more of these maybe smaller deals, but they are racking up in terms of volume of the number of listings that are happening. How do you view this sort of landscape now and the changing dynamics?
I think that distinction is important relative to the past. We had the SOE period. You go in, the global investment banks go in and try to do the privatization. Then we had the period of sort of the Alibaba, Tencent-led new wave. Then you had the competition of the local players, A-share listing. But as you well know, you now have contemporaneous AH listing.
Yes.
So you have to find ways to partner with the local incumbents such that the company feels comfortable that they're getting local advice, but they're also getting know-how on how to list globally. So that partnership, I think, is going to continue because the contemporaneous AH, the dual list, allows you to raise more capital across a broader investor base. So I think that norm is going to continue. I think with respect to the competitive environment, to be clear, it's as toughly fought as it ever has been. But these companies want to know what your EV and robotics expertise is within banking and research around the world. What are the developments that are going to make investors go overweight a particular robotics or biotech name that comes listed here relative to a weighting they have in Europe or the U.S. So the global perspective for asset managers and the ability to see that through the lens of the investment bankers effectively advising those companies is super important. The other piece is we have a very large equities business, prime brokerage and cash business. That's on the back of folks that want this exposure to the second most liquid market in the world.
Are you happy with your manpower complement? It seems like, do you have enough work? Do you have enough people? How does that dynamic work in your head in terms of
David,
where you need the resources?
that's such a great question because I've watched you guys for many years with folks that are sort of post-cyclically jumping in, wanting to hire a lot of people, and then folks that are... We tried to be pretty stable, 2,500 people in Hong Kong. That's been a stable number. Even with AI sort of invading the space and creating efficiency and effectiveness, you need folks that are facing clients. Our high net worth group, as you know, led by Vincent Choi, folks that are 25, 30-year players that can access the global network, but also have folks that have domain who are spending time in Seoul, spending time in Tokyo, spending time in Mumbai, and spending time in here, bringing a pan-Asia perspective. So there will be times when right now it feels bulled up in the investment banking space where we're maybe a little light, but then you lean on your global partners. What you want to avoid is feast or famine. Again, the clients see consistently whether you have a lifer or someone that just came on 18 months ago.
Is there definitely then no job cut discussions for 2026 then now, Ted?
Well, I think the reality with AI development is that you're constantly thinking about how there's greater efficiency, but then also effectiveness. So folks have to raise their game. There's going to be an ongoing sort of competitive threat, and that competitive threat is going to come from the highly digitized machine.
The robot.
The robot can do stuff, but in terms of overall staffing, I feel really good about what we have in Hong Kong. Really good.
Okay, you mentioned wealth. Let people hear from you. What's the wealth strategy for Morgan Stanley in Asia?
Well, I think the wealth strategy is to be well connected with our colleagues throughout Asia, but then to offer the clients sort of a global perspective. They are Asia-based, but they want to figure out how to allocate into the private assets class. They want to figure out how to have high risk-adjusted returns in a sort of a weaker dollar regime. They want uncorrelated risk. So bringing the globe to our wealth management clients here, I think, is very important. But then also, how well connected are they into the banking and research ecosystem? They're highly sophisticated. What does Morgan Stanley bring across what we like to call, as David and Yvonne, the integrated firm that makes the Morgan Stanley kit a little different than the guy down the street?
Has it become more competitive now, you think, in the wealth business?
I think one of the things we learned, excellent question, Yvonne. I think one of the things we learned about the wealth management business is scale matters. We were under scale for a lot of years. Now that business in the U.S. is a $7 trillion business, but it's still only 10% of the total TAM available. I think here, too, we've looked to try to be a scale player, sticking to the high net worth segment, making sure that we're operating with a certain channel, but scale matters, and we'll continue to build accordingly.
And how does Hong Kong dovetail into your plans in terms of wealth in mainland China? Is Hong Kong still the jump-off point?
Yes.
As far as many of the solutions are concerned?
Yes. Hong Kong is existentially important. It's the port for capital flows. It always has been, right through '97, right through the periods that we've had ups and downs, and then through COVID. I think Hong Kong is going to continue to be a financial center for many, many years to come. So the beachhead here, 2,500 people we have in Hong Kong, absolutely critical. So for those of us that come 2, 3, 4 times a year, it's important that clients see that we are very much committed to Hong Kong as the unique center that it is.
We were just talking to David Solomon from Goldman, saying he's heading to China. Do you have plans to head to the mainland, Ted?
Tomorrow, I'm on a different calendar. Tomorrow, I'm heading to Tokyo.
Okay.
Where we spend a lot of time. Japan, very important to us.
Sure.
China, important too. India, important too. This is one of the things that's quite extraordinary. You have 3 very different narratives. That's even before you get outside of the big 3.
Right.
And we know them. Like, we could do 5, 10, 15 minutes on each one. But for us, Japan is very important. We have a 25% partner in Mitsubishi UFJ. Yeah. They have held us since the financial crisis. We meet twice a year. We see each other quarterly. What's going on in Japan is truly extraordinary. And Japan's connectivity to the rest of Asia is important, too.
In what sense? Well, what's changed for you in Japan?
Well, what's changed is...
Apart from the interest rate that's there.
Well, okay, but that's critical here, because in a zero zombie type of economy, you have effectively yen and real estate and mattresses. Now they've been able to manufacture some inflation at a time when shareholders are now actively looking for governance. That changes the game a little bit. So now you have some real asset allocation. Importantly, given the demographics, you have, which is so much different than India, you have savings to investment over the decades to come. Who can bring the combination of investment banking, trading, and wealth management capability to Japan? That kind of setup. Well, in some respects, rule of law, that feels like the United States. And in Japan, much like Hong Kong, you can't tourist bank. You have to go 3, 4 times a year, 5, 10, 15 years running, 20 years running. And we have a fantastic partner in Mitsubishi. So the key piece of this is interest rates are part of it. Shareholder activism is part of it. Deregulation is part of it. And then the demography of folks living longer, they need to be able to generate a return to be able to live off their savings.
Are you happy with the partnership?
Love it. It's
nothing changes.
Nothing changes. Continuity is so important. But we have done 2.0 where we trade a bunch of we call it Alliance 2.0 where we trade a bunch of the FX. We've combined the research, and now we're starting to think about what 3.0 could look like. Yeah, very exciting. But again, one of the great things about Japan, and much like you're in Hong Kong and in India, there's no rush. 5, 10, 20, 30 years, but you need to have an installed base and you need to make the visits.
There's so many regulators from China here. I'm just wondering, what are you looking for in terms of China, and what could entice foreign banks like yourself to really ramp up investment in the mainland now?
Well, I think there has to be some element of de-escalation at the policy level, and I think we're starting to see that. I think that's important. I think for most of the traditional Western firms, Hong Kong will be the natural gateway. There's no reason to change that. Right. Getting back to your earlier excellent question with respect to underwriting, to the extent you can actually be a leader in accessing global capital by having contemporaneous A and H, okay, then you need to be able to bank the companies locally to make sure that there's the right kind of transparency. But then you can also try to find global investors to come in there too. So onshore, offshore, hybrid, I think very important for the asset management business, for the banking.
You mentioned about India, which, as you say, is a long-term game. I'm just wondering, in terms of what you see for that market, could it actually overtake China when it comes to the fees pool? Do you see that ever happening?
Well, ever is a really long. I mean, ever. I mean, we're just
doing vegetables, so we're hopefully going to live a long time.
Oh yeah. Well, what does that make me? Like, part of the plant here.
That's
you guys look a lot better than I do. I like India, but I like China. You don't have to make the choice. You have $1.5 billion and $1.4 billion on 8. I think that's the math, right? So that's a pretty big, percentage of the global population denominator. They can both win. India can learn something from China, though, in terms of how to think about industry winners. This is the big change here now onshore. You're seeing real global winners in biotech, for example. And I think India is watching that, figuring out how they can not just be the 1+, but they can start having category killers that don't just serve in domestic demand, because at some point they'll have a demographic challenge, right? It's just the nature of human history, but then how to be global competitors. These markets, it's an excellent point that you make with the comparison. These markets can learn from each other.
Ted, we got to leave it there, but thank you. Ted,
you guys are very good to see me.
Chairman and CEO at Morgan Stanley.
Thank you, David. Thanks,
I'll send it back to you.
Thanks very much.
Thank you.
Thank you.
Have a good day.
That's right. Our very own Yvonne Mann and David Inglis there at the HKMA event coming up in the next hour. We'll take a deep dive into the property market with JLL's Asia Pacific Head of Investor Intelligence, Pamela Ambler. Plus, we'll talk investment strategies with DSP Mutual Fund CEO Kalpesh Parekh. More ahead on Insight. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. China has called on the U.S. to avoid 4 sensitive issues, so a trade truce sealed by President Trump and Xi can hold. They highlight the broad array of disagreements that will test ties. And China's ambassador to the U.S., Xi Feng, named Taiwan, democracy and human rights, China's political system and development rights as Beijing's 4 red lines. He added that the most important thing is to respect each other's core interests and major concerns. According to the embassy, Xi made the remarks in a virtual speech to the U.S.-China Business Council event. And businesses are watching the trade tensions between China and the U.S. closely. Goldman Sachs CEO says the one-year truce is enough time for the two sides to reach a constructive trade deal. We spoke exclusively to David Solomon at the HKMA Global Financial Leaders Investment Summit.
Well, it seems like the meeting was constructive. I'm watching the news the same way you're all watching the news. I think at the moment, a de-escalation is a good thing, but there's obviously a lot of work to do to really arrive at a real stable deal that can endure, over a period of time. I'm encouraged by the prospect of a potential visit from the U.S. president that was telegraphed in the fall, but for the moment, I did not think the escalation on either side was constructive, and so. I much prefer a de-escalation. And I think both sides really had a purpose in that meeting to talk constructively, to have a more de-escalated environment. And that allows now for constructive conversations as they move forward.
One-year truce, though, is there pros and cons to that? What does that do to business?
Sorry, I couldn't hear you.
1 year truce, though, between the two. Is that a good or bad thing? I mean, what does it do in terms of business sentiment when there's a 12-month time frame now we're talking about?
It's better than an escalation at unreasonable levels, which is kind of where we were, over the most recent time. Trade negotiations are complicated, and there are a lot of issues on the table. They need thoughtful responses and responses that can be durable, that both sides embrace and get to the right place. Yes, there's some uncertainty because it's a 1 year, it's a 1 year delay in all of this, but it's also a realistic period of time to try to get the right kind of deal done so both economies can move forward in a constructive way. And look, these are the two most important economies in the world. I think it's very important that, we arrive in a better place where we can both participate constructively with each other in the global growth of the world.
I mean, speaking of, let me borrow your phrase, participate, there's been a resurgence in equity capital market raising here in Hong Kong. A lot of the Chinese companies, tech or otherwise, are raising capital for the future. I want to get your sense, as someone who sits in New York, you travel, of course, all around the world. Is there a lot of appetite now from US-based investors to participate by giving that capital to Chinese companies right now in order to realize their ambition?
Sure, there's more appetite for it than there was 12 months ago. I remember actually last November sitting in a dinner in the United States with a group of U.S. investors, and this topic came up, and there were a couple of investors that basically said we all should be looking to China, and the reason that had evolved that way is if you look last fall, the prices had gotten so cheap, the capital flows had moved so in the other direction that you just knew that things would come more into balance and there'd be a recycling. And we've seen that recycling. You've seen a big move in prices year over year. You've seen more foreign capital come in and start to participate. That's a fundamentally different question about the big capital allocators really fundamentally shifting their allocations up to be higher again. So foreign direct investment in China has come down. And I think one of the big questions is until we understand kind of the trade and the geopolitical landscape, it's harder to see significant shifts back to higher levels of foreign direct investment and more capital allocation. But for the moment, those flows are making for a better IPO market here and more opportunities here.
We've seen governments being, I guess, more involved in some of these business deals. I take a look at Intel, for example. I look at Nippon Steel, even CK Hutch, which Goldman Sachs was a sole advisor to. What's the advice now to clients now in terms of that intervention risk?
Well, you just mentioned three different deals, and they're completely different.
Right.
I mean, they're completely different. Governments are always going to opine and weigh in on different transactions. There are regulatory approvals in the United States. There's CFIUS. There are all sorts of issues where governments weigh in. That is a very different thing than a government taking an investment, in a specific company. Wouldn't surprise you, I'm not a big fan of that as a general practice. That doesn't mean there aren't exceptions, because I believe that the markets should allow capital formation and competition, around companies. And, this administration is in one or two situations. They're taking actions like that. As I said, I'm not black and white and dogmatic. There can be exceptional circumstances. But I don't think as a general practice, having governments take stakes in companies is the direction of travel we want our free market system to go.
And that was Goldman Sachs CEO David Solomon speaking with the China Show co-anchors Yvonne Mann and David Inglis. Now, President Trump may have grabbed the headlines during last week's Asia tour, but Bloomberg opinion columnist Karishma Vaswani argues deaf diplomacy made his Chinese rival Xi Jinping the star of the show. Karishma joins us now. I mean, you talk about how, the U.S. stole the headlines, China stole the show. Why?
Well, I think, Haslinda, let's give credit where credit is due. Donald Trump came to Asia. He had that 5-day trip. He signed deals.
He turned up.
He turned up, but he didn't stay for the APEC meeting. And that's what Xi Jinping did, right? When it was actually quite an amazing split screen to watch. After the two of them had the discussion in South Korea about the trade deal that David Solomon was just talking about to your audience, they, all these television screens showed an image of Air Force One leaving and Xi Jinping's car taking him to the APEC gathering. And in that moment, it struck me that he is the leader that sticks around. And, you know, we know this. Face time really matters in Asia, doesn't it? And when you're there at these kinds of international gatherings and regional summits, and you're the one on the global stage basically saying, we champion, China is a champion of globalization, China believes in supply chain stability, you know, we want countries to trade together, get rich, and let's be glorious, in the words of former Chinese leaders. That's a really compelling message at a time when the U.S. is sort of doing its America First, transactional-based, both economic and foreign policy. Obviously, there are caveats and concerns around China championing itself as a, globalization poster child, not least because of the fact that it restricts access to its own market. But I think at a time of such instability in the world, it was a very good game to play.
And also, the messaging has been consistent. We are here, we want to be a partner, we want to cooperate. But for Trump, it ain't too shabby. I mean, he did walk away with a lot of deals, rare earths in particular.
Yeah, I think that was really interesting. And I think it speaks to the fact that, one, the United States has clocked that this is massive leverage on the side of the Chinese, because they were able to pull out effectively their trump card by saying, you're going to come after us on tech? Well, guess what? We own the majority of the world's rare earth supplies. But, you know, as I'm sure lots of people have told you, these rare earths aren't that rare at all. They are actually in many parts of the world. It's just that China has built the infrastructure to get access to these critical minerals like 15, 20 years ago. Now, what Trump and the administration, the White House, has done as a result of signing these agreements with Thailand, Australia, Japan, and Malaysia is effectively start the ball rolling so that in the future, the U.S. won't be in such a difficult position.
So we talk about how face time is important. I mean, what's in it for China now? What's the strategy in this part of the world?
Well, you know, ask the question, what does China want? And typically the answer you'll get is a world that is kind and beneficial to China. And I think that that's true and that's right. You know, China sees itself as an equal to the United States, as a peer when it comes to this sort of global great game of power, but also in terms of economic security. It's simply about ensuring that China has the resources that it needs to continue to grow in the way that it wants to. And this is all about political stability and legitimacy for the Chinese Communist Party, whose main aim is to survive. And it's got to look after its citizens first, right? So it needs to project this image of a powerful nation on the global stage, the country that didn't have to capitulate to Trump. You know, in the lead up to the meeting with Xi Jinping, you had all these Asian leaders giving gifts of all kinds, you know, golden crown, golf paraphernalia. China didn't do that. It stood on the stage with Donald Trump, and that's a really important message for citizens back home.
Also, it has a lot of leverage.
Yes, it does, and I think it played its cards really well this time around. I think what will be interesting going forward, you know, when you look at the one-year trade truce, how long these agreements can hold, because the one key issue for China is the unification with Taiwan. It is the red line that Xi Jinping sees as the way that he fulfills his legacy, and I think that will be a really interesting tension point to watch between the two countries.
Karishma, great perspective there. Bloomberg opinion columnist Karishma Vaswani there with us. Now, still ahead this hour, JLL's APAC Investor Intelligence Head discusses the global impact on an uncertain Fed rate outlook.
Keep an open mind. This really means assessing the incoming information, keep an open mind, and make the decision that balances those risks and ensures that the economy can go on and achieve this soft landing.
I think that the Fed is too restrictive. I think that neutral is quite a ways below where current policy is. And given my rather more sanguine outlook on inflation than some of the other members of the committee, I don't see a reason for keeping policy as restrictive for a long period of time as we are. The longer you keep policy restrictive, the more you run the risk that monetary policy itself causes a downturn in the economy.
Fed officials offered contrasting views on the outlook for further rate cuts, with Chicago Fed President Austin Goolsbee also chiming in, saying he's more concerned about inflation than the job market in the U.S. And that same concern was echoed by the RBA in this part of the world. Australia's central bank held its key interest rate steady, warning of stronger inflationary pressures in the economy and reaffirming that future moves will be guided by incoming data. Let's discuss how the evolving interest rate dynamics are impacting the commercial real estate sector. Pamela Ambler is head of APAC Investor Intelligence at JLL, which just released its latest report on real estate investment transactions and trends. Good to have you with us.
Thanks for having me.
We've been talking about how, central banks have managed to perhaps put a lid on inflation, but here we are again talking about inflation, being resistant, being sticky. How is it influencing the thinking when it comes to commercial real estate?
Yeah, certainly when the decision came out from the Reserve Bank of Australia today, I think it was no surprise. We know that inflation does stay very sticky for a long time. And I think the investors have anticipated that, which is why we can see reflective in the investment volumes and appetite for Australia. It has been held back a little bit. So there hasn't been too much of an uptick, whereas we've seen an uptick across most other Asia markets.
Such as?
Japan in particular, and Korea also seeing a surge of cross-border, specifically capital. Because keep in mind, all of these markets have a very strong and robust domestic liquidity pool. And so when it comes to the rate environment, there's also another thing to keep in mind. Lower cost of debt is certainly good for investments, but also commercial real estate investors like to look at the risk-free rate, which is the 10-year bond yield. We have seen in the past, in 2024, where even when there are rate cuts that occurred, the longer-term bond yields actually move higher. That is a result of when investors believe that the central banks are front-running. It's to support growth rather than to control inflation. And that's sort of the juncture where we are right now.
And that's what we're seeing for most of Asia. Central bankers here are more willing to cut rates versus the Fed, for instance. And hence, we're seeing capital flowing from perhaps the U.S. to Asia?
Yes, certainly. So the U.S., the Fed, having cut their rates by 25 basis points, now further takes pressure off the Asian central banks from a currency standpoint. So before, a lot of Asian central banks have sort of front-run in terms of managing the expectations, seeing inflation coming down. A lot of these export-oriented markets reacted before the Fed did. And that divergence is now closing a little bit, which takes the pressure off of Asian central banks to further decrease rates.
Where are the opportunities? We talk about Japan, we talk about Australia, even Singapore, some say. But one of the key themes when it comes to infrastructure properties, also about data centers and how AI is driving the appetite. How is that playing out?
Yeah. AI, of course, is a big topic in discussion on very many fronts. AI, when it comes to disrupting the workforce and people and the utilization of office space, that is one conversation. And certainly we have seen a number of job cuts occur across tech companies particularly. But that is very compartmentalized when it comes to the studies that we've seen, the longer-term impacts. There are certain types of jobs that will be disrupted. But keeping in mind, tech is only a 20%, if not less, of the overall tenant occupancy on an aggregate. There are many other industries. Added to that, there is the demand coming from the growth for Asian economies, from finance, from other sectors. So let's part that aside. When it comes to AI and the demand for data centers, it is all about power. If you can secure power, you can build data centers. And now there is this so-called format called neoclouds. So they are specifically addressing the needs of high-density GPUs and GPUs as a service provider. And those will continue to see larger amounts of investments because it requires very large upfront capital capex. And so the end users wouldn't be able to go it alone. You need larger amounts of not just commercial real estate funds invested, but also funds from the infrastructure side.
So how are your clients positioning themselves with regards to that?
Yeah, increasingly we are seeing funds in the past where they had a real estate allocation and an infrastructure allocation now both sitting under real assets. And so they can go in and they can invest alongside each other, or they can decide, depending on the project, whether it's in development phase or if it's stabilized, who would do the financing. And so there are various different ways of gaining mining exposure from a financing standpoint. And also on the infrastructure side, there is a lot of renewable energy investments because these are all going to be stable power sources that will ultimately power the data centers.
I want to touch on China. We had the Chinese financial regulator speaking in Hong Kong just earlier today, talking about how there is stability returning to the property sector in China. Is that a sense that you're getting as well?
When we talk about stabilizing for China, there are still lots of challenges. When our research teams are forecasting, looking at the rents, the vacancy rates, which are still relatively high, rents are still coming down, capital value is coming down for the next 12 to 18 months, it will still be challenging. But when an investor is looking at investing, they're oftentimes looking at dislocation. And so if they can pinpoint, which is very difficult to do, a timing where they're catching the bottom of the market, any sort of signs of stabilization will give them the indication to begin looking into investing in that market in preparation for that market to hit a trough and a bottom and pick up the upside.
You know, you talk about dislocation. When it comes to the Chinese economy, we're looking at a government that's possibly wanting to prop up with perhaps stimulus. And, you know, we're looking at a U.S. economy that is looking to slow down, perhaps data suggesting that. I mean, how do you, I guess, channel your capital seeing that dislocation between the two economies?
Yeah, well, when it comes to the U.S. and China, there are many other capital sources. So when we talk about the U.S. capital bucket, for example, oftentimes there are large U.S. asset managers or private equity groups that are fundraising from a multitude of sources, and we do call them global capital. They have various different strategies that are certain ones are under special situations, for example, that might be looking at those opportunities and markets where there are pockets of distress, where there is not enough liquidity. And certainly China, when it comes to those sort of opportunities exist, it's just whether or not there is the right appetite in terms of a risk premium that has the appetite and the longer term vision and view to invest
China has bottomed, though, right? The property market?
We wouldn't say it's bottomed. It's trying to reach a bottom. It's working its way through a lot of the challenges. When it comes to, as I mentioned, vacancy rates, it's still elevated, higher than the average of most of the aggregate markets we see here, higher than the long-term average. But the absorption and the demand is being filled by services industries, the robust, of course, AI. When you talk about the prowess of the AI developments and companies, it really stands to be between the U.S. and in China.
How are you assessing the default risk in China? Is it still very high?
Default as in not being able to pay back loans. Well, we are seeing banks, they're
cash-strapped property developers.
Yeah. Well, when it comes to developers, they have various different means of finding ways to refinance. So one of the buckets of capital we work with is private credit. Private credit can be an alternative to working with banks to extend loans that no longer make sense for the bank to hold. Private credit also offers different types of flexibility that banks might not be able to offer or might not be able to extend. And so private credit is really where we're seeing, and you do hear about that being talked a lot in the U.S. It's a much more mature market, much lesser to a degree in Asia Pacific. The non-banks account for less than 10% of the overall lending activity.
But surely there must be some concerns. Private credit is pretty opaque. It's illiquid. The risks are there.
But the returns are large.
So it is about returns, it's about yield. Where do you find the biggest returns and yields in Asia?
Well, when it comes to yield compression, it's beginning to come through in certain markets in the logistics space and as well as retail, particularly in Australia and in Seoul, Korea. Those are the areas where we're seeing yield compression beginning to come through. Because for so long, yields have expanded. And now, because rental growth is improving, because the cost of debt is coming down lower, we're seeing a lot more creative opportunities.
How about in a market like Singapore? We have seen capital flowing into Singapore. What's driving that? And is that sustainable? Is this about stability? I mean, you know, in the long term, it is about stability. It's about this constant yield.
Yeah. Well, Singapore has always been considered a safe haven market. And the way in which we've seen it manifest itself is this year there's been several listings on the public market for REITs, real estate trusts, one of which was a data center REIT, and one is for worker dormitory. So worker dormitories is part of the broader living theme. There's a structural undersupply of living no matter where you go. Nobody is saying living is affordable. Everybody is complaining about the cost of living being high. And so, you know, of the various different formats, whether it's co-living that addresses some of the student housing demand and needs where there's a shortage, or on the multifamily front, and then, of course, senior living as a segment that has a hospitality layer to that, all of those are gaining a lot of attention. Although in terms of deployment, those are generally much smaller scale size deals as opposed to the larger quantum 250 million, 500 million U.S. office towers, or some that we've even seen trade above $1 billion.
Pamela, you know, if you speak to market participants, they always point to the fact that the economies in this part of the world have yet to be hit fully by the U.S. tariffs. Might that derail the optimism that you're expressing about this part of the world?
Yeah, that's really interesting because the talks are ongoing, right? And so the latest with Trump coming to Southeast Asia and having various different trade agreements, we wouldn't necessarily characterize it as having a positive outcome, but at least we have some more certainty. Roughly 19-20% tariffs is where we're sitting at, with the removal of certain goods and products being excluded from that. And so the demand is lies within the shifts of the supply chain, and we will continue to see that being recreated.
Pamela, thank you so much for your insights today. Pamela Ambler of GLL. Coming up, DSP Mutual Fund CEO Kalpesh Parekh will be weighing in on the debate of valuations in India's IPO market. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Here's a quick check on the Indian markets. Nearly an hour after the open, we have the Nifty and the Sensex in negative territory, under pressure after snapping a two-day losing streak on Monday. We've been keeping an eye on the INR, the rupee, in focus as it hovers near a record low 88.58 right now. Sources telling Bloomberg that the RBI has been selling small amounts of dollars over the past few days to defend the currency. Currently, we have the Indian rupee trading up versus the USD, up 0.2%. Now, staying with India, Indian eyewear retailer Lenskart sold out its IPO in less than 5 hours last week. But despite strong investor appetite, concerns are mounting that the valuation may be stretched. The offering follows a string of startups that have listed since 2021 and are now trading below their issue prices. Let's cross to Mumbai, and our Asia equities reporter Ashutosh Joshi is with us. Ashutosh, we know that Lenskart's IPO valuation continues to attract debate in India, but, you know, it was still sold out in barely 5 hours. What's happening?
Yeah, hi. Thanks for having me on the show. IPO season in India continues to boom. Last month, we saw close to $5 billion worth of companies' IPOs being priced. Lenskart, which is a startup looking to list and debut on Indian markets, is looking to raise $800 million. This company's valuation has sort of created a debate among investors. Some of investors have voiced concern that the valuation is quite lofty. However, at the same time, we have seen some of mutual fund, some of domestic institutions, such as DSP Mutual Fund, coming out in public and explaining their investment rationale. We are also seeing a strong participation from foreign as well as Indian domestic investors and retailers in this IPO. That is despite the concerns over the valuations. What our reporting shows is that investors are willing to pay a higher price for companies that offer the growth potential. India has had 30 odd startups getting listed in last 3 or 4 years. Most of them have done well. Obviously, there are some cases which have seen sharp failures, but companies such as Zomato have been the poster boys of this boom, and these examples are driving investors to consider putting money on new startups coming with ideas that can go ahead.
You talk about Zomato among the 30-odd listings that we've seen. Talk to us about their post-IPO performance and, you know, what is expected from them in the months ahead.
Yeah, we are expecting more IPOs to come during the month of December, and that should take India close to its record year of IPOs. Starting today, we are seeing online brokerage grow, starting its bidding for its public offering. We also, a couple of big names are lined up for in coming months that keeps investment bankers as well as markets busy with IPOs. Lenskart will be listing early next week, and its anchor book was also supported by strong names, and the IPO was sold out on first day itself, which indicates potential for a strong debut.
Ashutosh, thank you so much for that. Asia Equities reporter Ashutosh Joshi. Now, according to stock exchange data, DSP Asset Managers invested about $10 million in Lenskart's IPO through its mid-cap equity fund as an anchor investor. Let's get insights from Kalpesh, Parekh, MD and CEO of DSP Mutual Fund, one of India's largest quant funds. Kalpesh, good to have you with us. Isn't this IPO so expensive? We're talking about valuations of in excess of $820 million. It is expensive, isn't it?
So, Haslinda, we don't comment on individual stocks, and especially when the IPOs are going on. So it won't be right for me to make any comment specifically on any particular company on a public forum.
But 45 times forward earnings on a normal occasion, is that okay? How would it look for companies looking to IPO?
So I think, see, in the last few years, there are so many new profit pools which have emerged in the Indian market, and new business models which have emerged, whether it is in consumer tech, whether it is in wealth management. 4 asset managements have got listed in the last few years, and some of them have created immense amount of wealth. Exchanges have got listed, and as money managers, what we do is we always analyze companies around their future prospects, around their pedigree, like we do for any listed stock. So I think that, like in the listed market, there are existing companies which make money and don't make money. So is the case with the IPOs. From our perspective, like I said, in the last few years, we've been invested in so many wealth management companies, a couple of asset management companies, and we decide how to allocate capital. And largely, 95 to 98% of our portfolios are in existing stocks, and that has done well for us.
Kalpen, what is attractive about Lenskart? Is it the fact that it is scalable? It is a scalable business. Is that a good enough reason to be investing in this company?
So, Haslinda, you'll have to call me a couple of months later, because like I said, when the IPO is on, we generally don't comment on individual stocks. Either ways, I represent an asset management company which is $26 billion. So happy to talk about the broad markets and broad strategies and ideology that we have. I will not be able to speak specific on individual stocks.
Are you concerned that the current market, if you talk about, the broad macro picture of the Indian market, it's been propped up by retail investors? Is there reason to be concerned that retail investors are propping it up while foreign investors are pulling out? And we're talking about in excess of $16 billion for the year.
So I think, every market goes through its cycles of growth and valuations. What we have to look back is over the last 35 years now. 35 years is a long history of 3.5 decades. Indian markets have, in dollar terms, in spite of a 3% currency depreciation, outperformed any other market in the world. And the primary reason for that is, Indian corporate sector offers very attractive return on equity, return on capital, almost 16% ROCs, the highest in the world, barring, maybe US. So you have capital efficiency. There is a 12 to 14% long-term earnings growth rate in this market, and promoters have respected capital, and shareholders have been rewarded. So I think in that context, India has deservingly been a premium market compared to most other markets over the last decade or so. No doubt, when you are at 25 times to earnings multiple, markets are a bit stretched, maybe 1 year ahead of fair value. But last year, we've already seen that consolidation. In the last 1 year, Indian markets have been broadly flat, and which makes them, move closer to their fair value and take away some of the fraud. And the beauty about investors in India who are investing over the last 6 years now, this is the 53rd month in a row where Indian investors have continuously kept on investing, is they are not investing at a point in time. They are investing every month. So in the last 6 years, investors have bought the COVID lows. They have bought the lows that happened at Ukraine-Russia war. They bought the lows during the Israel war or the India-Pak geopolitical. So in 5 years, you've got 4 lows intermittently. And this series of money coming in every month through something called as SIPs has really benefited investors because they have not bought at highs. They've bought all through ups and downs. And I think it is the discipline of investing which is creating a very disciplined cult of investing in India in the last so many years.
So foreign investors are missing out, you say. You say the froth is gone, it's fair value. What would you say then?
No, I think, every investor has choices in the world, right? Global investors have choices to invest across the world, including India. And even today, global investors have been investing in India since '93. It's been 32 years. They've been as loyal or more loyal to Indian markets than even Indian investors. And there are periods when they do profit booking, they rebalance. So having seen, some parts of the market becoming frothy. So, last year, let's say exactly 1 year back in 2024, September, when our markets were expensive, there were two sides of the market. You had banking stocks which for 5 years had earned less than a savings account return on the stock. And then on the other hand, you had industrials and engineering stocks which were at a premium. So in the same market, there were two components, and there are opportunities. So I think global investors have rebalanced after almost 2 decades of significant returns. And I think last year, relatively, they had opportunities in China, in Asia, in Europe. To some extent, they've rebalanced. And I think it's part of the game. It is allowing markets to remain, more meaningful in terms of valuations and not becoming euphoric, and which is great for an investor who's coming in today.
Right. Kalpen, one of the reasons why foreign investors are not convinced about the Indian market is actually to do with the currency. The Indian rupee continues to be weak. In fact, even intervention by the RBI has not managed to provide that support consistently for a longer term. How are you reading into this weakness in the Indian currency?
So, Haslinda, the way we always tell global investors is if you look at last 30 years in India, the currency generally depreciates by 3%. And that's a very long-term trend. So every year there is a range of depreciation between 2% to 5%. Some years it is 5, some years it is 2. A couple of years there is marginal consolidation or appreciation. This year, primarily, one of the reasons has been, I think, largely, the rise in interest rates globally, whereas Indian rates have remained fairly stable because our inflation and macro deficits are at its best ever shape. But on the other hand, the tariff uncertainty, India and US are yet to conclude on tariff talks, and as and when that gets concluded, you will see some consolidation on our currency. But we are not concerned with the fact that every year there is a 3% currency depreciation loss. But in spite of that, in local currency, Indian markets have delivered 14% long-term returns over 10, 20, or 30 years. If you take out 3% of currency depreciation, that still comes to 11% dollar depreciation, dollar returns on a 15% return on capital market. So I think this is an order. This is not a new bug. It is a feature of every emerging market, which typically tends to have depreciation of its currency. As long as earnings growth makes up for it, investors are happy.
Would you agree that, there's a limit to what the RBI can do, especially when it's also, the currency's weakness is also a function of a resilient dollar?
Absolutely. So see, if you remember 13 years back, 12 years back in 2013, India was part of so-called Fragile Five. And from that day till today, there has been huge improvement in our twin deficits, whether it is the current account deficit or the fiscal deficit. India's inflation has toned down from highs of 8-9% 10 years back down to 3 to 4%. So a lot of our inner operating statistics as a country have stabilized significantly. Inflation has been under control, deficits under control. So in that sense, RBI may not have as much to worry as it was 10, 15 years back. In fact, the rest of the world is struggling with very high inflation, very high leverage, very high debt, sovereign debt. India has been very prudent all through even the COVID period. The government did not expand its balance sheet and maintained macro stability. I think after 2013-14, a very primary objective for the government of India and Reserve Bank was to ensure macro stability, and I think they have executed that very well. There are always these bouts of 1 or 2% excess depreciation in any market, but I think it's part of the routine journey.
Kalpesh, I want to talk about the asset management space. It's getting pretty competitive. You have new rivals, the likes of Geo, BlackRock. How are you assessing this new landscape of new competitors?
See, I think we have around 50 asset management companies in India, and any space which has fast growth. Our industry has grown by around 25% in the last 6 years. Like I said, 53rd month in a row of inflows continuing month after month. Will obviously attract new players. There are global players who want to come into India. There are domestic boutiques who want to get into the asset management space. So definitely it becomes competitive. It keeps us on our toes. The person who has to celebrate the most is the consumer. In the last 7-8 years, SEBI has been one of the finest regulators to make our industry very transparent. I think we are the only industry where there is existence of something called as direct plans. There is existence of something called as categorization of funds. So we have all large cap funds which have a framework. All mid cap funds have a framework. So like-to-like comparison can be done by investors. And we have the most cost-efficient structure. There is a concept called telescopic pricing. As the size of our assets goes up, automatically the fees or the expenses that we charge comes down, which means the investor gets economics, the scale economy benefits. So this has led to great outcomes for our investors. And on top of it, the digital infrastructure in India has enabled consumers in the smallest of villages to invest by pressing 2 buttons and starting a mutual fund investment. So I think this infrastructure creation, the digital infrastructure creation, the payment infrastructure, and the fact that the market has rewarded investors will bring in more competition, will keep us on our toes, will make choices available for investors for their better outcomes.
You talk about the cost structure, the fee structure. Of course, we know SEBI is overhauling the fee structure. When it is formalized, I'm just wondering what you see the impact would be on your margins, on your business.
So I think what SEBI is doing, it's a white paper, and that's again another beauty about our regulator, that they come up with a white paper a few months in advance. They create a dialogue with all the market participants so that there is practical input which is taken. What I see is that they are doing 2 things here. One, they are still rationalizing the fee structure. May have a few basis points, maybe at best 3 to 7 basis points of impact on the margin, but too early to say at this point in time because it's still in the white paper stage and discussions are on. But more importantly, it's making it more transparent. A lot of statutory levies like taxation or GST cost, which was layered inside the fees, will get very clearly demarcated. The second thing SEBI is also doing is bringing down the cost of broking. So every time we buy and sell the stock on the exchange, we pay certain basis point to our brokers. That cost also is likely to come down. So overall, the entire impact is not on the asset managers alone. It is getting distributed between the ecosystem. So at best, 3 to 5 basis point is what my rough indicative calculation today is, but too early to say because we are still in very early stages of dialogue. And once it is out, I'll be able to give more clarity.
So even though it is white paper stage still, you welcome the changes that will be implemented by SEBI when they happen? Is that a fair assumption to make?
Absolutely.
Kalpesh, before we let you go, I'm just wondering, given the current market environment, how best to play India at this stage?
I think, this is what we've been advocating to all our investors in India and to even our global investors, that you're getting invest in equities, but then with a very long-term horizon of 5 years and above, whether you come from Asia or Europe or any part of the world, including in India. Alternatively, to our Indian investors, we recommend them to invest in hybrid funds, which is a mix of stocks and bonds. Bonds are earning around 7.5% yields, and in a very stable macro regime, there is a reasonable possibility of bonds to also, yields to go down, which can create room for high carry as well as some bit of mark-to-market. So good mix of 70-30 in stocks and bonds is a good way to invest. And there are pockets in India now, very large sectors like banks are at reasonable valuations. Tech stocks are down 25% this year. They are coming closer to 4% free cash flow yield. They are 15% of our market cap. So almost half the market is at fairly priced valuations. There is some part of the market which is frothy like anywhere else in the world. There is no market in the last 1 year which has not risen sharply. So I'm not worried about valuation risk because that's true everywhere in the world. The only way to solve for it is good quality businesses and longer time horizon.
Great perspective there, Kalpen. Thank you so much for your time today. Kalpen Parekh, MD and CEO of DSP Mutual Fund. Now, still to come, Adani Enterprises, the flagship of Gautam Adani's ports to power conglomerate, reports earnings today. We have a preview of what to watch. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Shares of Adani's flagship unit, Adani Enterprises, are in focus ahead of its earnings report later Tuesday. Investors will be watching for its fundraising plans and the performance of Adani Airport Holdings. Earlier on the show, we spoke to GQG Partners Brian Kersmanc about how he views the company's stock ahead of the earnings report.
Like gravity. So as long as the companies continue to put up, these robust earnings over the course of time, the market will appreciate the growth in the businesses over the course of time. I don't believe that you're going to see a multiple derating from here. These are actually priced at pretty attractive levels here. Again, if you do any sort of sum of the parts on any of the businesses for Adani Enterprises, you actually see that there is tremendous amount of value that's unlocked.
For more on what to expect, let's bring in Bloomberg Conglomerates reporter PR Sanjay in Mumbai. Sanjay, tell us about what is expected. What kind of numbers?
Adani Enterprise, the flagship company, which incubates several businesses, including data centers, real estate, airport, green hydrogen, and several others, would be reporting its quarterly earnings today. And the most important number people are watching is it's not its net income, but it is looking at what is the kind of money they would be raising via rights issue, because now they're entering into a fresh capital expenditure cycle, because airport is ready. They are looking at demerging the airport business and to get an IPO by 2027. And at the same time, they are also increasing their business footprint in data centers, which we had witnessed, tying up with Bharti Airtel and Google, etc. And the most interesting leg here is another leg is green hydrogen, where we are expecting more transaction. So to fund all this, they have to have a new capex cycle. So the first and foremost thing, what we are expecting today's board meeting is like what is the kind of a rights issue which Adani Enterprises, the flagship and the incubating company of Adani Group, the port-to-power conglomerate, would be doing. That is the most interesting thing. And of course, analysts are also waiting for the net income, because always the coal trading can have a drag. So they're also waiting kind of a narration on what happened to the coal trading and how it is impacted, because we know that the other unit companies like Adani Power or Adani ports or various other businesses have done extremely well. So we are waiting for the street is waiting for the numbers, net income, and the rights issue, the fundraising initiative.
You talk about the fundraising. It is a reflection of how the momentum is now picking up. I mean, this is a company that wants to build a global empire, and this fundraising is testimony to that.
Of course, it's also a kind of a reflection of how the promoters are seeing the company. Since it's a rights issue, at least 70% of the fund will have to be poured in by the promoters. So they believe their own company, of course, that will have a repercussion, that will have a positive reflections among the investors. And when investors also became that road assets and real estate assets and airports are doing extremely well, what now they would want more fund for airports and for the green hydrogen business. So this rights issue fundraising is very crucial, that can have a very positive impact on long term for Adani Enterprises, which will be now incubating for the new line of businesses as well.
Sanjay, thank you so much for that. Bloomberg Conglomerates report up here. Sanjay, in Mumbai. Before we go, here's a look at our guests for tomorrow. We'll get exclusive market insights from Natixis CIB's APAC CEO, Bruno Lassagne, plus Avinia Growth Capital founder, will be joining us to discuss why they're betting big on Indian companies like Zepto and Zedwork. And that is it for Insight. Horizon